Good morning, good afternoon, good evening. Welcome to another episode of Playbook of the Wealthy. My name is Dave Grant. My co-host is Heather Townsend. We are covering Trump's big, beautiful bill, version 2. We are focusing on how this impacts retirees. If you haven't been here before, our podcast is run in 4 sections. You get to know us professionally, personally. We dive into content, and then we answer questions. If this is your first time, listen to it all the way through. And then you can decide if you want to like, comment, subscribe, follow, send it to your mom, the group chat, if you want to do one or all of those things. If you have been here before, thank you for your likes, comments, and etc. Please keep giving them because they're awesome and I like reviewing them, especially the comments. Thank you.
Dave does love the comments. I don't
print them and I pin them on the wall. I don't. So, first section of our podcast, it has no name because we change it all the time. But Heather, how are you in your practice?
I'm doing great.
You know that's the answer you give every time, right?
Is it?
Yeah. Well, and it's that word as well.
Great. Well, I love my business. I mean, I don't have any. I'm just busy. All right. How about this? It's still summer. Lisa actually laughs about it because she's like, your practice is the most unusual practice I've ever worked for. For some reason, Fridays are always my busiest day. Today, I don't have client meetings. I try to get all the work done of the week that I couldn't get to. And it is the busiest day. Have no idea why. And summer, not light for me. Not at all. And do you know what else I'm doing? This might be why. I'm doing a lot of RMDs right now to get them out of the way while the market is high.
Fair enough.
Yeah, I don't want to wait till year end, especially with the new tax bill and all the tax planning that's going to happen. So yes, there. That was not a great answer. That was what's going on. Are you happy now, Dave?
Very. Always.
Listeners, I am no longer going to say I'm doing great on my practice. That word terrible. Is not allowed.
All right. I've actually got 2. I'm going to piggyback on what you said. I have clients spending money like none other right now, and I love it. They're sending me all these emails like, give me this cash. I need it for this. I need it for that. I'm like, yes, spend it. Enjoy your money. Take it. Mm-hmm. So that's what they're doing with the summer. One thing about this podcast and the other one I run, which is called the 5-Minute Retirement Plan. If you've not looked it up, pause this episode. Go take a look. We are hitting consistent views on YouTube every time we release a video, both the long form and the shorts. We're getting about 1,000 views every time we release a video.
Our podcast.
Yes.
People like us, Dave.
They do, especially the shorts.
Okay, but can I say something really quick? That feels good because the reason I'm doing this podcast, which I think is for you too, is I just want to share knowledge. And so I'm glad that it's reaching people. I'm happy that you're finding this valuable. That's one of my whys. So that makes me feel good.
Okay. If you missed it from the last episode, I found the soundboard in our software, so I'm going to abuse that sucker.
Can I say it? I just never know. I mean, I know you like the ownership, so am I allowed?
Depends if you do it right.
Let's dive in.
All right, we're in it now because Heather told us to do it. If you got an email from the Social Security Administration that told you there's no tax on Social Security, I want you to write a letter to Social Security and tell them that they're liars, because they were.
No, they misled. But did we actually tell listeners what we're talking about today? My brain has been so much in taxes. Did we say what this episode was?
Yeah, thanks for listening to my intro.
But I mean, don't we also say, let's dive in, like we are going to talk about all the things in this tax code that affect retirees?
And now they know.
We really are good friends. I mean, this is literally how we communicate with each other. All right. Yes. Mislead. My husband, he edited my newsletter and blog as I wrote about this, and he made me use the word mislead. I said mistake on their part. He didn't like that. It was a mislead.
Well, they took the wording from the White House report that said that was like 85% of people collecting Social Security because of changes will not have taxes to pay on their Social Security. That's not how the tax code works at all. And so I don't know why they then sent that email out saying there's no tax on Social Security. but there are changes to the tax code which will enable people to pay less taxes on their Social Security. So it's that whole roundabout of you didn't use the right words.
Well, and it is still taxable, but I do think, I do believe that I could see 85% of people that receive Social Security are now not going to pay taxes. I could see that, but it is still taxable. That is a very big asterisk.
So the tax code has not changed, but there are some things that have changed which may allow you to pay less taxes on your Social Security.
And
they include. So first of all, the standard deductions are going up. There's been a slight increase on the standard deduction that you get per person. There's now 2 new ones of if you are over 65. Sorry, this one isn't new, but if you're over 65, you get an extra portion on your over 65 deduction. If you're a single filer, it's $2,000. If you're a joint filer, it's $1,600 each.
Okay, that's where I'm. Okay, so
that's if you're over 65.
So $15,750 plus your 2. So you were $17,750 before if you were single. Let's just say now
you get the new one, which is the $6,000 personal exemption if you're over 65.
In addition to that $17,750 I just said.
So, but this one is now subject to income limits. So that's $6,000. So if you're single and you start to earn over $75,000, it's going to start to get phased out. And if you're married filing jointly, if you earn over $150,000, it's going to start to get phased out. So don't get too excited just yet.
And this is where it's interesting. In my retirees, I'd say 2, I have to pay attention to this. And then the others, like not even close. Like the income limit kind of really made me go, womp.
So I think this really affects low income America.
Mm-hmm.
When I say low income, don't get offended if you do get that $6,000 exemption. But if you have a pension, 2 Social Securities, and you're also pulling out your investment and retirement accounts, you're flying past this exemption limit and you're going to get phased out.
I do think it's interesting though. So, I mean, it's a huge exemption if you're married though. I think the total is what, $45,600? Is that the right amount?
Yes.
Like you're married, you have income, you can make up to $45,000 of income and pay no taxes on it. That's substantial.
So this is where income design is so important. Mm-hmm. So if you've got cash lined up for the next couple of years of your retirement that you're going to live on, that's all tax free. Now you have so much extra room over and above what you did last year in order to do Roth conversions, in order to move your deductions around and just really get the most bang for your buck out of the tax code.
You know what else is interesting about this? This is retroactive. It starts this year. This is one of those 2025 through 2028 items, which even makes planning even more interesting because it's like you only now have it this year through 2028 and then it goes away.
Mm-hmm. It's going to cause a lot of people to scramble like through the end of the year to say, okay, the Roth conversion number that we thought we had, do we need to revise that? Because now we've got more exemption to work with.
Planning. The one thing that I will say, again, I'm opinionated, we all know this, is I'm actually very thankful of the government this time that they passed the tax law mid-year instead of the last 3 that have been at year end. Like we actually have half a year to plan and absorb these rules and understand them and run scenarios. I mean, that's really nice. I really have not enjoyed my holidays understanding tax law, and I'm glad we had it mid-year. I'm grateful. Thank you. Can we make that kind of a new rule? Thanks.
I agree. I think software companies are happy for that run tax softwares, and they're like, thank you. We now have 6 months to change our software.
Yes. This should be actually a requirement, I think. Like, government, you want to change the tax laws, you have to do it mid-year, period. Okay.
That was for the Trump administration. Thank you very much. Okay. Well, the thing that this new exemption and increased limits does bring in is you're going to have to run 2 side-by-side tax projections. Because yes, you have this increased exemption amount, but now the itemized deductions and SALT, which we talked about in the previous episode, they're all changing. So if you have previously looked at doing itemized deductions but realize it's not much of a benefit for you, you have to look at that again. Because now you can start to deduct state income taxes. Let's say your pension is taxed at a state income tax level. If you've got real estate taxes that are going way above the exemption, you need to look at this as well as what you can do with the increased deduction.
Do you know what a lot of people also forget in SALT that is deductible is tag renewals on your car? Just FYI, just giving a tip, but you renew your, the tag renewals that go on your license plate, there's a tax on that, and that includes it. Most people, I haven't even been asking many of my clients because they've been getting capped out at the 10, but now with going up to 40, it's going to come into a thing. So, but I agree with you as we're talking about this. It's people in high income or high tax rate states, Oregon, California, New York, that now are going to itemize, but are in that kind of income threshold. Planning this year is really exciting.
Mm-hmm. Yeah, it's important. This is where your CPA or your advisor who does taxes is going to shine or not. Mm-hmm. And you get to evaluate them. Yeah. Spoiler, Heather and I are going to shine. You better watch out.
We're already all over this bill. We're all over this bill.
Tax brackets. I'm not going to go too much into this, but they stay the same, which Heather and I really like because that makes planning predictable. We don't have to adjust all our planning for different tax brackets and trying to not have people jump into more. I know for me, this really helps with Roth conversions because now I know, okay, if someone's income is consistent, the tax bracket is the same, we can be very deliberate on what that Roth conversion is going to be, and we don't have to adjust it towards the end of the year to avoid tax brackets.
You do so many more Roth conversions than me. I think your clients are more different mindset than mine. I show them that break even and they're like, nope, don't want to take that risk.
A lot of mine are first couple of years of retirement. If they don't have a pension, they're living off cash. So we're dealing with very low tax brackets.
Oh, that's different. Yeah.
Or they're dealing with such a lopsided portfolio that they need to, else they're going to get whacked by a tax torpedo once RMD comes down.
Most of mine are pretty balanced. One has a very high IRA, but we're taking it so early that by the time Social Security won't be as big of an RMD issue. It's very fascinating. It's very like this is where planning is. No client is the same. No client's plan is the same. Depends on so many factors. All right.
If you are looking at doing charitable contributions for the next, say, 3 years, and you've got the means, it may be worth it to lump sum it in 2025. Because once you start going into 2026, you're going to hit phase out rules. Itemized deduction is going to start to skew things if we go into different scenarios. To keep it simple, if you can lump sum it this year, that would be ideal.
Well, and this is where it gets so, our tax code. But if you talk about donor advised funds, for my clients that do them, we use stock, right? Appreciated stock. I'm not selling the stock to add to AGI. I'm directly transferring the stock to the donor advised fund. But then that limits the amount that you can deduct because it's not cash. So any contributions that aren't cash have a lower percent of AGI. And so I'm already limited in a lot of those ways up to their income. More what I'm trying to say is planning is just so important because if someone's like, oh, I can just deduct all of my charity this year. Like, no, it's a little more complicated than that. There are limits to income and then it rolls over. And that's, some of my clients do have carryovers of charitable contributions. So then I'm like, well, how's that going to affect with the floor? Like the carryovers are now getting reduced. I mean, this is plan scenarios. Try to maximize.
Agreed. Salt and Pepper. Great band. Love their singing. SALT, which is state and local taxes. Again, we did go through this in our previous episode, but this is important for retirees too. So there's a change in the exemption amounts going through 2029. So it has been capped at $10,000.
Random.
So if you're looking to deduct real estate taxes, income taxes, local taxes, you could only deduct up to $10,000 if you're itemizing. That has now gone up to $40,000 if you're married filing jointly. So you're able to deduct a lot more. So this is, again, you got to do this side by side. So yes, the $40,000 limit is there, but if your standard deductions lump on top of each other and you get that $45,600 like max limit on the standard deduction, you may not want to itemize. You may get more bang for your buck out the standard deduction.
Well, and I mean, I don't think most retirees are in this situation because I try to limit an income to a certain tax bracket. So I'd be surprised. But if you're making over 500,000 of income, you start getting reduced on the SALT limit.
Yes.
600, you're down to the 10K again. So.
Yeah, those are usually the one-offs, aren't they?
Yeah.
The income
that's
of
like
500,000.
they're selling a rental property. This is like you're selling a rental property, business exit, something like that. That's normally where I see this come into play. And so you got some planning here.
All right. If you're buying a car, you get to deduct the interest if it's a U.S. assembled car. Very niche.
And you have to provide the VIN. Did you know that? You have to provide the VIN.
I didn't. Yeah, they're going to be tracking that for years. So yeah, you can deduct up to $10,000 a year in interest. Again, income limits, $100,000 if you're single, $200,000 if you're joint.
I also think it has to be a new car, right? This isn't used. I think it's only new.
Yeah, a new car coming off a U.S. assembly line.
Yep.
So thankfully, Tesla's come off a U.S. assembly line. So, I win.
So you're going to keep your income in that bracket on purpose?
Oh crap! I forgot that. Dang it!
That's where it gets sounds so exciting, but then it's like, well, and that's actually an interesting thing because it's like people making 100,000 or 200 joint. I mean, I know cars are expensive, but how big is their interest on I hope they're not buying $100,000 car.
I mean, it would be $100,000 at what, 10%? It's going to get you $10,000 a year. That's a terrible car loan. So you're not going to be able to deduct the full amount. So yeah, this is going to affect a small amount of people in order to get the full deduction.
I'm curious how this plays out, to be honest. But I guess for our retirees, it's going to be an interesting calculation because if we're keeping them in that income range, then, it's, do we not put as much down? Does the interest really help them? The deduction, right? Like, because retirees can probably buy a car outright, but then you're jumping tax brackets and what's that doing? Or AGI limits. So it's fascinating.
And this is a deduction. This is something I haven't checked, but is this falling under the itemized deductions or is this above the line?
Yeah, I don't know. I need regs on that.
So another to be determined.
And but this is also an example right here of why I don't like pulling huge lump sums of retiree money. Let's say someone already Roth converted beginning of the year. I wait till the end of the year when you have all information. Because if you Roth converted in the beginning of the year and a client also bought a car, you might have phased them out of some of this stuff.
I agree. I do all my Roth conversions at the end of the year.
Yeah.
Like when I do my client full reviews, we know the income, but I do pull out the portfolio in lump sums to buy cars. Partly, some clients have that comfort level. They don't have any debt and they don't want to mess with it again.
I know you have the no debt clients.
Not all of them.
Okay.
But it's that gut check of, yeah, I paid off my mortgage. Why am I going to add more debt? I've got the money. And if it's in a taxable account and it's not going to trigger much in taxes, I'll just buy the car now. Whatever. All right. Your estate tax limit is now locked at $15 million a person. It was right around there, but it was due to go a lot lower at the end of 2025.
It was like almost 14, right? 14. It was almost 14 million. So we got increased by
right around there. Yeah.
Yeah. Like one more million.
It's got inflation adjustments each year. So this goes up. If you're married, you have this per person. So now you've got a $30 million estate exemption before you'll pay any taxes on what you leave your heirs. Note that this is also a gift tax limit exemption for your lifetime as well. So you don't have to wait until you die to leave all this money and not pay taxes. You can gift it throughout your lifetime and not pay any taxes as long as you're doing the correct tax filing paperwork.
There are definitely some strategies here. The interesting thing, though, that at least how my estate planning attorney is, and I really respect, that's why I use him a lot. I saw him speak on stage and I was like, you're my new estate planning attorney that I'm recommending. Because he gave these examples of when you have clients that are in their 30s and 40s, and I know we're talking about retirees right now, but even if they're in their 60s, let's say, right? Like, I don't want to do anything too permanent right now and make things super complicated with all these different trusts and I mean, if it makes sense, it makes sense. But also there's a point where you don't want to make anything too permanent when people are still young. On states, though, to go back to retirees, states have different estate tax exemptions. And so what? Washington, Illinois, Minnesota, Oregon, that I'm just naming some off the top of my head. There's a few have lower estate tax limits. So this doesn't mean estate tax is completely gone. It kind of depends on what state you're living in.
Yeah, some of them are big. Illinois is still at 4 million, while the estate for federal is 15. So there's definitely some
big gap. That's a big
huge
gap. It's a huge gap. And I think a lot more people fall into the 4 than 15.
Agreed.
Mm-hmm.
If you want a lot more meat on this bill, go listen to the episode where we covered high income and business owners, because some of those do apply to retired people, but we wanted to just focus on the purely retired issues here.
I think the thing on the retirees that I'm going to go back to is it is interesting that extra $6,000 per person, $12,000 married, that does, since that is expiring at the end of 2028, that is an extra $12,000 of not taxable income if you're in that income bracket. Like you need to pay attention to that. There is some planning there, very much so.
All right, we're going into our section called What Would You Do? These are questions related to this content. And number 1, my husband and I just turned 65 last year and earn $125,000 from all of our income sources. I've heard our tax situation is going to be changing. Is that true?
I mean, I just talked about it.
Yes.
Yeah. What is that income limit again? I can't remember this whole bill. What is it? 150, right?
150 is the start of the phase out.
So they're under that. So they just got an extra $12,000 plus what the standard deduction on married increased for what, by $1,500? Is that right?
Yes. So all in, you're at $45,600.
Yeah. I mean, that's huge. I'd say you're going to pay a lot less taxes, and maybe you should consider Roth conversions, but not where you get out of that exemption. Okay, my wife and I are 62 and have 2 homes, one in Tennessee and the other in New Jersey. We are about to receive $150,000 in extra income and are looking to find ways to reduce the taxes on this. Does Trump's BBB offer any benefits?
It does. One thing I'd like to know is what your current income is, because yes, it offers benefits, but there's some phase outs. So let's say this $150,000 doesn't bump you over $500,000. There is some extra ways that you can get some increased deductions. So you're in New Jersey, your real estate taxes, you're selling a child every year to pay your real estate taxes. They're a lot. Now you don't have that cap on how much you can deduct. You're up to $40,000 as long as you hit below an income limit. I would be careful about charitable deductions, just because you're going to start to hit some caps if you start to get to a high income limit. So depending on what you're trying to do in terms of reducing your taxes, just be careful, because a lot of income is going to start to be phasing out some of these increases.
I think there's just so much in this bill that I'm realizing even with these questions. And it's interesting because one thing I said to my clients is I was like, the good news for you is I already know your whole financial world and I can just filter where these apply to you, or if you're thinking about something. This would be a lot for someone who doesn't have a tax preparer, planner, strategist, or financial advisor. This is a lot. I know. I'm going on a little bit of tangent, but it just...
No, it's true though. I mean, I was even sat at a baseball game last night talking about the EV credits and why I bought the car now. And people are like, I didn't even realize it was going away.
No.
Wow, okay. So you have to be educated if you're going to take advantage of all these things.
Or pay someone to keep you educated. All right. Keep going. All All right, next question.
I am 68, have been doing Roth conversions of $50,000 per year. I'd like to keep doing these until my RMDs kick in. How will my tax situation change with the big, beautiful bill?
With that 50,000, are they taking Social Security? Do they have a pension, right? Like, what are they taking from investments? But those Roth conversions, is that kicking him out of getting that extra 65 plus standard? What is that called? Personal exemption now? What are they calling that?
Personal exemption.
Personal exemption. Okay, they're back again. Yay. Remember about the net investment tax. I think that one is not talked about a lot. At 200, you start getting phased in of another 3.8% tax automatically added on your investment income. If you're over that threshold, or 250 married filing joint. And I really try to keep my retirees under that. So just have a scenario run with the new bill and play around with it. But I'd be worried about the standard that personal exemption you're phasing yourself out of. And it's
I agree. That's important. You got to figure out where do these exemptions kick in and where do they phase out with what income you're generating each year, and what are you comfortable giving up versus doing the conversion. Because there's the payoff. It may be worth paying the tax now for the Roth conversion if you're going to leave it alone for the next 20 years and give up some of the exemption now. Sometimes it may not be worth it.
And it also depends on the goals, right? Like if we had talked about this in one of our other podcasts, but if they're giving this to younger children in 10, 15 years, and these children are high income earners that are in 37% tax bracket, it still might make sense for you to be Roth converting if this is you want this to go to your kids if they're and pay no taxes because they're in such a high tax bracket. Again, really depends on someone's plan.
All right, let's go into highlights. Highlights is our section where we tell you our personal wins of the week. And mine is all about baseball.
Oh, summer baseball. Summer
As a
baseball.
British person.
The British person
talking about baseball. This is weird.
Like, Americanized summer baseball.
So it actually involves my son, who plays travel baseball, has done for the last 4 years. But he got to the end of his baseball season and decided that he's done ever playing baseball again. And we're like, oh, okay, walk us through that. And he's like, yeah, I'm done. But then as he got to the end of the season and then started to verbalize why he was doing it, because the winter training schedule is too much for him, he then decided, I'm going to play it again. We'd already told his coaches he was done. And thankfully, he's a good baseball player. So the coaches turned around and said, how can we keep him? Like, do we have to bring someone else on the team who's his friend? Like, what do we need to do? Thankfully, that was the situation. So he could then turn around and say, oh, I'd like to play again. And they're like, oh, thank goodness.
But did he negotiate that he doesn't want the winter to be as grueling?
Yes.
Smart kid. I'm proud of him.
They're allowing him to do half the workouts for the winter versus the whole thing.
Wait, and
is still once a week. The winter workouts are twice a week.
But how about all the other kids? Do they have to do the... Oh, I don't know if I like that. Oh, I don't like that. That's preferential treatment. I don't know if I like that. Miss Fair one over here. Like, no.
Well, the coaches aren't going to say that to all the kids, but that was a negotiating tool for him to get back on the team, which is great for him because it allows him to do other sports, which he wants to do. What about you?
So, backstory, I swear my dog, my Bernese Mountain Dog, has been the greatest gift of my life. And I have many stories of this. I swear she gave me the twins. So here's another one. So I was walking her one night. And the backstory of all of this is, I think I've shared that the place we normally rent every summer has been sold, private deal. And I'm devastated, jealous of the new owners. Name anything under the sun, I'm very upset about it. Yeah. And they are from Florida, so I know that they're going to want to use it in the summer. So I am just very upset because I have no idea where we're renting next summer. I feel like our whole future summers are in a mess. Mm-hmm. Well, I'm walking Peanut. Yes, the Bernese Mountain Dog's name is Peanut. I am walking Peanut, and she is pulling me. And I'm like, I don't want to go talk to the neighbors right now. I don't want to. I don't want to. And she is 90 pounds and very strong. So I sometimes don't have a choice. And she pulled me over there. And the neighbor, little did I know, wants to rent the unit and is happily going to let us rent the unit next summer. And we're the exception. And it's a nicer unit than the one we're staying in.
Wow. That's great. Did you negotiate the price already?
I'm working on that part.
I'm sure you are.
I'm working on that part. But I mean, I'm thinking of, Miss Transparent Ethical Heather. I'm just going to take a screenshot of what we paid for here and be like, how about this for this many nights? Like, try to get the same rate.
Yeah. Well, that's good because you were in a tizzy last week.
I was. But my dog, like, I was really mad at her. And then it was the greatest gift. It's like, how did she know? Like, she doesn't normally do this. And it's like, if she hadn't dragged me over there to talk to these neighbors, I would have never been in this situation. The gift that keeps giving.
Good job, Peanut.
I know. So, and I also told my husband, I was like, this is the year that we are going to get ahead of our travel. No more last minute travel. He is beside himself right now because I have now committed us to next summer already. I got our nanny lined up. I'm like, get on this. This is the new way. This is the new way. I love it. The planner is very happy right now.
Oh, God bless him.
You understand. I can tell right now. You're like, I know how he feels right now. Yeah.
Mm-hmm. Yep. We haven't even finished this summer, and next summer's already planned.
Yep.
Jordan, you're up.
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.
Thanks, sir. All right. Thank you for listening to this episode of Playbook of the Wealthy. If you want to listen to more, you can find us on whichever platform you listen to podcasts. If you want to watch the video version, we're on YouTube, LinkedIn, and Instagram. And if you want to send us a message, you can do hello@playbookotw.com. And we'll see you next time.
Email us. I like the questions. And I said it like that. I said it like that so that people email in questions because I love them. I love when they do.
All right. I just had to laugh at you. Goodbye.
Toodles.